Okay, Chapter 9. We're going to totally switch gears. We've finished our discussion of of corporations and their consolidation and all those fun chapters of all those journal entries with elimination and consolidation entries. We've talked foreign currency translation. Now we're going to get into partnerships, and our final area will be on government accounting. So let's get right to it. We're going to be looking at actually the formation, the operation, and the dissolution of partnerships. Now, some of you may have had some of this in other classes, but I'm teaching it as if you've never heard of it. So what's a partnership? It's defined as an association of two or more people to carry on a business as co-owners for a profit. And there's quite a few, nearly 4.5 million partnerships. Now, why do people form them? Reduce expenses. Instead of having two standalone businesses, combine them. Increase expertise and expand services. There's tax benefits to being a partnership. They're easily created by families and friends. You don't need permission from the government to become a partnership. Some professions have just historically not permitted incorporation, so this is their next best alternative. What are the advantages? We have flexibility when we're a partnership to how profits and losses, management operating decisions may be shared independent of ownership percentages. Ease of formation and dissolution. You could basically wake up, call somebody up and say, let's be a partnership, and you've got one. Taxes. Their flow through. What does this mean? It means when the partnership makes net income or taxable income for tax purposes, the partnership itself does not pay taxes. The income is flowed through or reported to the individual partnerships. They get a percentage of each part of the taxable income, and then they pay income tax on that money on their tax return. Then when the partner takes money out of the partnership, it's not double taxed as long as they don't take more out than the net income they've reported on their tax return over the years. Disadvantages, it's with anything with sole proprietorships. You have unlimited liability. You are jointly and severally liable for the liabilities of the partnership. Mutual agency. Each partner has the right to incur liabilities in the name of the partnership. So if you have a partner that loves to rack up bills, you're stuck with them. Inability to participate in various corporate tax benefits. So there are some drawbacks tax-wise. But for the most part, a partnership is just a two or more people getting together and opening up a business. Now, there are some other forms of business out there. These are really dictated by the tax code. So a corporation can have itself known as an S corporation, and a lot of people who maybe they want like 2 or 3 or 4 people want to get together and have a business, but they don't want to be a partnership because of the unlimited liability, may take this route. They form a corporation, so they have limited liability as owners, but they're known as an S corp for tax purposes. And what this means is you have the protection legally as any other corporation. You can't have more than 100 stockholders to be known as an S corp. Actually, I think it's 250 now. Owners are limited, so the only people that could own stock in this type of corporation are individuals, estates, and certain tax-exempt entities and trusts. Okay. Like a partnership, the income of this type of corporation flows through to the shareholders of the corporation, and the shareholders are taxed on their tax return for the profits of the S corporation. I'll give you a quick example. Years ago, when I was on my second marriage, I've only been married twice, but my husband at the time wanted to start his own business. It was a trucking related business. So we definitely said we need to be a corporation to protect our personal assets in case there's ever a lawsuit or something. So what we did was we formed a corporation, and at the time, the big thing was the S corp status. So what did this do for us? Well, this was his livelihood. And most people that are in these small corporations, it's your livelihood. You're not doing this for kicks as an investment, like somebody investing on the stock exchange on, buying Google or Apple and just putting money there and saying, well, if I want to take it out, I can. No, this is how we earned a living. And that's one of the major reasons that this type of taxing entity was created, the S Corp. At the end of the year, I would compute our taxable income in the corporation. Now, he drew a salary out of the corporation. It was low, but he was an employee of the corporation. Then I would figure out the net profit of the corporation. And I was a 50% stockholder. He was a 50% stockholder. What we would do is 50% of the profits would be in my name and reported as my income. 50% of the profits would be in his name and put in his income. Now, we filed a joint tax return, but we paid as individuals income tax on that. And that's how an S Corp works. So it's more from the taxing side. There's other limited partnerships are something that can also be used. What a limited partnership is a partnership that has one general partner. A general partner is the person who's responsible for all the liabilities of the corporation. It's usually a corporation. Or of the partnership, I mean, and it's usually a corporation who takes on that general partnership role. Limited partners are like investors. They're like little shareholders, but they call them limited partners. Okay, losses are restricted for limited partners to the amount that they have invested. They do share in the profits and losses of the partnership, just like a normal partner would, on a limited basis. The other type, limited liability partnerships. Owners risk their own investments. They are responsible for contractual debts of the business. Owners are liable for their own acts, though, not for all the partners. So it's just another form of a partnership. Here's the other big type of, this is the new hot entity, the LLC. They're a new type of organization for the United States. They're big in Europe. They are classified as partnerships for tax purposes. So an LLC, a limited liability company, is exactly that. The owners have limited liability. But for tax purposes, it's like you're a partnership if you have more than one owner. And if you're one owner, it's like you're still a sole proprietor for doing your tax return. Now, why did they do that? Because if you're sitting there saying, well, an S Corp kind of does the same thing. Here's the deal. Take it back to my situation. My husband at the time was very lucky. He had a wife who was an accountant, a CPA, who knew how to do a corporate tax return, an S Corp return, because you still need to file a tax return when you are an S Corp. It's an information return reporting to the IRS how much the corporation made and who should be reporting the money on their tax return. That costs a lot of money if you had to go out and hire an accountant to do that. So this type of corporation or company was created to alleviate that financial burden on someone. Why be an S Corp? Just let them file their tax return the way they always have. They'll still have corporate protection. So the owners have limited liability for the company's debts, but they'll file their tax return like they're still a sole proprietor or partnership, cutting down their cost of preparing a tax return. And that's why they did it. Okay, so we've seen all the different types of entities that you could come across, and you will, if you haven't already, see them in tax classes. Let's get back to the partnership and how accounting is dealt with for a partnership. The equity section of a partnership is like a sole proprietor, except it has a capital balance for each partner. Profit and losses for each period are allocated to each partner's capital account. And withdrawals by partners reduce their capital accounts, or they may have a separate withdrawal account for each partner. So it's not this whole new type of accounting. The major difference is in the equity section. So you'll have a partner's equity section on your balance sheet now, and each partner will have a capital account. Partnerships usually can exist even in the absence of a written partnership agreement. I don't suggest it because the best of intentions could end up really terrible. If you have two friends get together, form a business, oh, we don't need an agreement, and then there's a falling out, you have a major problem. So no matter what your relationship is, I always say, get a written document from the get-go, a legal document that spells everything out about your partnership. The Uniform Partnership Act establishes standards and rules for partnerships. A written agreement will supersede, though, the UPA. So if you don't have a written agreement, they're going to the Uniform Partnership Act. What's usually dealt with in a partnership agreement is the name and address of each partner, where you're located, what you do, your rights and responsibilities as a partner, how much money you're going to, or money and assets you're going to contribute into the partnership, and how you're going to allocate profit and losses. Other things that could be addressed here is dissolution of the partnership, how you can leave the partnership. A partner can leave it. You don't want to predict that, but heck, have it defined just in case. Periodic withdrawals of assets by each partner is more. Procedure for admitting, there we go. Method for arbitrating partnership disputes. When you get in an argument, how are you going to deal with it? And what happens when a partner dies, withdraws, or retires. So once we have all those things defined, we open up our partnership and we start our business. What happens that first day with that very first transaction of contributing capital and starting the business? Well, the initial transaction is the contribution the original partners make to start the business. That's how every business is started. An owner has to put money or assets into a company. In the simplest situation, the partner's investment is only cash. You debit cash, you credit the capital accounts of the partners, you have a partnership. What happens though if a partner contributes other assets, non-cash assets like inventory and land and equipment or building? Well, we'll value those types of assets in the partnership at fair value and then allocate that to the capital accounts of the partners. Contributed intangible assets require some special consideration. We're not going to go through them, but it is talked about on page 428. Contributions made by one or more of the partners may go beyond assets and liabilities. For example, a particular line of expertise or an established clientele. So they're bringing more than solid assets. So we could use either the bonus method or Goodwill method when we're recording intangible assets, and we'll be taking a look at those. Now, James and Joyce plan to open an advertising agency. James contributes cash of 70 grand, Joyce 10 grand. Joyce, however, is an accomplished graphic artist, a skill that is considered especially valuable to this, so there's their special talent. James and Joyce have contributed a total of $80,000 in identifiable assets to their partnership. Identifiable being their 70 grand in cash, 10 grand in cash, 80 together, and they decide to have equal capital balance. Under the bonus method, this assumes that Joyce's artistic abilities do not constitute a recordable asset in the partnership. This approach recognizes only the assets that are physically transferred to the business. And this is how we would debit cash for $80,000. We do not keep separate cash contributed by James, cash contributed by Joyce. No. Once they take it from their own personal stash, it's the partnership's. So the partnership has one cash account. Now, their capital balances will start at equal amounts. 40 grand to James, 40 grand to Joyce. Essentially what happened here is that because Joyce has these special talents, she was bonused $30,000 from James into her capital account. Because remember, whatever is in a partner's capital account is the amount of money they could take out of the partnership. That's up for withdrawal, right? It's like she put that in there, but she didn't physically put the 40,000 in, but her abilities did that. The Goodwill method says something else. It's based on the assumption that an implied value can be calculated and recorded for the intangible contribution made by a partner. So in the present illustration, Joyce invested 10 grand cash, 60,000 less than James, but receives an equal amount of capital according to the partnership agreement. Really what it's saying is, okay, if she's going to get an equal amount and James gives 70 grand, we're going to assume Joyce gave 70 grand as well, an equal amount. Now she didn't give it in cash, but she's bringing it in as goodwill to the company, and we will debit an asset, goodwill 60 grand, debit cash 80 grand. So James isn't going to bonus her or anything. What he puts in is his capital balance. It's assumed then that Joyce gives $10,000 cash, and her artistic ability, she brings that goodwill to the company of 60 grand. Remember goodwill. Okay? This is the ability of the company to make more because of this very intangible thing, and Joyce has it. Now, that's how we start the business. Items to be allocated once we start the business. Interest on capital balances if it's defined in the partnership agreement. Compensation, bonuses, and then if there's any remaining income. So once we start the partnership, we start doing the business of the partnership. We make the initial journal entry for the contributions by the owners, either on the bonus or the Goodwill method. And then we start producing income. How do we allocate that income? That should be defined in the partnership agreement. These are some of the ways. The allocation of income is not necessarily based on the relative capital balances. You could allocate income any way you want. You just don't go, oh, the capital balance for James is 70, Joyce is 70, we'll just allocate it equally. No. This is a separately negotiated item. So it's however the partners want to do it. What we're going to look at are some common ways that partners will allocate net income. Assume Tinker, Evers, and Chance, 3 people, form a partnership. They invest cash of 120 Tinker, 90 Evers, and 75 Chance. The partnership agreement says that Evers will get 40% of the profit. Tinker and Chance are to divide the remaining 60% equally, so they'll each get 30%. So they get a 4-3-3. This agreement also stipulates that each partner is allowed to withdraw $10,000 in cash annually from the business. Net income for the period is 60 grand. So this is all defined in that partnership agreement. When we're closing net income to the capital accounts at the end of the year, remember we do our closing journal entry, if you're remembering financial accounting, where you debit the revenue, credit your expenses, and then you have to move net income into capital. We used to move it to retained earnings. Well, we are going to take that $60,000 and allocate it based on the percentages defined in the partnership agreement. The first 40% goes to Evers' capital account, so we'll credit Evers' capital. Tinker and Chance both get 30%, so they'll get a credit of $18,000 each in theirs. Now, that's how the journal entry would be done. In a partnership, you'd have a statement of stockholders' equity in a corporation, a statement of owner's equity in a sole proprietorship. In a partnership, they have a statement of partner's capital. What that does is define how each partner's capital account has changed during the year. So we'll start with the beginning balance of each partner. Remember, Tinker had $120,000 allocated as beginning balance, Evers 90 grand, and Chance 75 grand. We'll add their net income allocation and then subtract the amount of cash they were allowed to take out, assuming they did take it out, 10 grand. And that will give us their capital balances at the end of the year. And then an overall capital balance for the partnership of $315,000. That would be on the balance sheet. Now, drawings, remember, are just like dividends from a corporation, but they're handled differently. They just subtract them out of the capital balance. There's no retained earnings in a partnership. Now, assume the original facts of Tinker, Evers, and Chance, except an article of a partnership agreement credits each partner annually for interest equal to 10% of their beginning capital balance for the year. Then, the next step is Evers and Chance will also be allocated $15,000 each as a compensation allowance because of their participation in operations. And if there's any profit left, it will be split 40%, 30%, 30% as it was before. So there's 3 separate allocations occurring here. You take them one by one. So the first step is whatever the beginning balance is in each of the partners' capital accounts, multiply that by 10%. That's the first allocation of the $60,000 in net income. So Tinker had a $120,000 balance, so he'll get the first $12,000 net income allocated to him. Evers was $90,000, so he'll have $9,000 of the net income allocated to him. Chance's was $75,000 beginning capital balance times 10%, $7,500. So in this scenario, the first $28,500 is allocated of the $60,000 of net income. The next $30,000 is split between Evers and Chance. So far, $58,500 of the $60,000 in income have been allocated. There's only $1,500 left to allocate, and we base that on a 40%, 30%, 30%. So we're not taking the profits and allocating it all 40, 30, 30. We take these things in steps, and it's just defined in the partnership agreement. Now, once we take each of those steps, find out the amount for each partner, we add up their total amount of net income that would be allocated to them. So Tinker will have $12,450. You could see his capital account is credited for that much. Evers is $24,600, the 9, the 15, and the 600, 24,600, credit to his account. And then Chance would be a total of $22,950, which would be credited to his capital account. So it's just a different way of determining the amount of net income allocated to each partner, and that will be defined in a partnership agreement. So the assignment process is a series of mechanical steps. That's all. The number of different allocation procedures that can be employed is limited solely by the partner's imagination. So you just read the partnership agreement and allocate according to what they came up with. Remember, our journal entry is the same. It's just the dollar amount is determined by the partnership agreement. Although interest, compensation allowances, and various ratios are the predominant factors encountered in practice, there are numerous other possibilities. So we're just giving you a flavor of what you might come across here when allocating net income to each partner or loss. Okay, so we've looked at beginning the partnership, establishing it, the advantages and disadvantages, formation, there we go, the articles of incorporation, and allocating income. Now, the next section, legal dissolution. How does a corporation dissolve? Well, there's a couple different ways. Any alteration in the specific individuals composing a partnership results in a, quote, legal dissolution. I remember learning this when I was 18, 19 years old, going, they got to shut the place down and then restart it. Oh my gosh, what a headache. No, we don't shut it down. We continue doing business, but legally, it's a legal dissolution that there's new partners. How could this happen? A partner leaves. They just get sick of it. They leave. They retire. They die. Or an admission of a new partner occurs. This frequently leads to immediate formation of a new partnership as business continues. It can also lead to a termination and liquidation of the partnership. So it doesn't mean it's always going to continue to operate. Sometimes these things happen and the business decides to liquidate, sell off all of its assets, pay the liabilities, and distribute the rest of the money to the partners. Now, an individual partner's ownership rights include the right to co-ownership in the business property, the right to share in profit and losses, and the right to participate in management. Now, These two rights can be sold. However, the third right cannot. When the makeup of the partnership changes, the partnership is legally dissolved. A new partnership is immediately formed. The new partner acquires partnership interest by either purchasing it from the other partners or making a contribution to the partnership and being a brand new partner. So these all affect our accounting. A new partner can purchase the partnership interest directly from the existing partner. So let's say you have partnership A, B, and C. D wants to be a partner in partnership A, B, and C. D can go to A, B, and C and say, hey, I want to be your fourth partner. But A, B, and C are not interested in that. But C says, hey, they only want 3 partners. I'm ready to get out of here. Why don't you buy my interest and you could go in as if you're me? So the cash goes to C, not to the partnership. So this is just a matter of really changing a capital balance, capital account's name from capital C to capital D. That's all you do in that situation. Because there's no money physically going into the partnership, it doesn't affect the financial position. What happens when that's not the case? Well, there's 2 methods are available to account for the transfer of ownership. The book value approach and the goodwill approach. The goodwill approach is where we're going to actually revalue the company to fair market value at the transfer. Let's look at an example. Assume Scott, Thompson, and York, so STY, formed a partnership and subsequently York decides to leave. He offers to sell his interest to Morgan. Although York may transfer the right of property ownership as well as the specified share of future profits and losses, the partnership does not automatically admit Morgan. York legally remains a partner until such time as both Scott and Thompson agree to allow Morgan to participate in the management of the business. That was a example of those rights. What will happen is the capital balances and profit and loss ratios for Scott, Thompson, and York prior to the transfer are as follows. Scott has a $50,000 balance, Thompson 30, York 20. So, and their profit and loss ratio, you notice their profit and loss ratio does not coincide with their ownership percentage. Scott owns 50% of the business, but his profit and loss ratio is 20%. Thompson has a 50% profit and loss ratio, and York a 30%. Now this information is defined on page 436 if you want to refer back to it. Under the book value method, instead of York selling his interest to Morgan, okay, each of these 3 partners elects to transfer a 20% interest to Morgan for a total payment of $30,000 in a simple capital reclassification. The money is paid directly to the owners. Okay, so each of these 3 partners elects to transfer a 20% interest, so they don't want York to leave. They'll admit Morgan in, and what they're actually doing is saying, we'll give you 20% of our balance for a 20% interest. You'll get a 20% interest. So we credit a new capital account for Morgan for $20,000. Okay, now why 20,000? Well, the value of the partnership is $100,000. That's the capital balance. 20% of that, $20,000. And then 20% of the capital balance of Scott will be debited 10 grand. So he actually reduces his capital account. Thompson reduces his 6 grand, 20% of 30, and then York reduces his 4. Now if you're sitting there going, well, yeah, but that's not fair. Well, wait a second. Morgan paid them on the side. So he didn't put the money into the partnership. He kind of bought that balance from them for 30 grand and only has an interest of 20. So he paid 30,000 for something for $20,000. Why would you do that? He really wanted to be in this partnership. He knows he'll make the money. This is the book value approach. The goodwill approach does something differently. Legally, the partnership is transferring all assets and liabilities to the partnership. According to the Goodwill Method, a transaction is occurring between two separate reporting entities, an event that necessitates the complete revaluation of all assets and liabilities. So, bottom of page 436. Because Morgan is paying $30,000 to someone, he's really saying that the business that he's really saying, I'm willing to give $30,000 for a 20% interest in something. Well, what is the total value of that interest? We'll take the $30,000 he's saying he'll give for a 20% interest. Divide the 20% into 30,000, and it has a value of $150,000. So the fair market value, how it's being looked at for the company, is $150,000. But according to the capital balances, it's only $100,000. So the first step is, we've got to get that $50,000 extra on the books of the partnership. We have to revalue it to what Morgan is saying it's truly worth. If he's giving 30 grand for a 20% interest, it must be worth 150. Now you could debit specific accounts for the increase in fair value, but we're just going to keep it simple and debit an asset goodwill, 50 grand. Now, 20% of that 50 grand will be allocated to Scott, 50% to Thompson, and 30% to York. Okay, and that's based on their profit and loss ratio. That's where we get those percentages from. So we just increased all their accounts. Then, when he does pay that $30,000 in, he's going to have a balance of $30,000. And the old partners will bonus that $30,000 just like they did the 20, based on 20% ownership. But you have to remember something. Scott's balance in his capital account is no longer $50,000. In the journal entry before that, we added $10,000 more to it. So now we'll be taking 20% of the $60,000 out of his account. Thompson will be taking 20% of $5,500. So make sure you take a look at that. Make sure you see where that's coming from. York, previous balance is 20 grand. We added another 15 in the prior journal entry. His capital balance is at 35,000. So what we're doing here is we're revaluing the business according to what the new partner is saying it's worth, increasing the capital accounts of the old owners, and then bringing the new partner in at their value. The 20% is the value of the assets being contributed. Goodwill approach. The new partner can also gain partnership interest by contributing cash to the partnership. So in this method, they're not giving it to the partners on the side, they're putting the money directly into the partnership, increasing the assets of the partnership. Remember that the new cash, there you go. Two methods are bonus approach, goodwill approach. So let's take a look at how we would handle this situation. An outsider may be admitted to a partnership by contributing directly to the business. Here we go. Assume King and Wilson have a partnership and presently report capital balances of $80,000 and $20,000 respectively. Now, this information is on page 437. According to the Articles of Partnership, King is entitled to 60% of the profits. I got to write this down. and Wilson is 40%, and I'm just going to write down their capital balances, 80 and 20. Okay, cool. Now, Goldman wants to give $20,000 cash into the business and get a 10% interest in the partnership. Okay, 20 grand, 10%. Here's the bonus. In the bonus approach, we say, okay, he's bringing in cash of $20,000. Prior, the balance of capital is $100,000, $80,000 King, $20,000 Wilson. we're going to add the $20,000 of new assets coming into the business. So now the total assets to the partnership are $120,000. So you take the total capital balances before the new assets, add the new assets, get a total new partnership capital balance. What percentage of that is Goldman going to own? 10%. So he's giving $20,000 cash into the partnership, debit cash, but his balance in capital, take a look at that. He's only being credited 12 grand. What happens to the other 8,000? We call that a bonus to the old partners. The old partners get to increase their capital balances according to their profit and loss ratio for the difference. So 60% of the 8,000 will go into King's capital account, 40% Wilson. Now, why would that happen again? Once again, Goldman really wants to be in the partnership, and he's cool with that. He's okay. Now, the other way to handle this is goodwill. What would happen then? Well, if Goldman is willing to give $20,000 cash for a 10% interest, he feels the partnership has a $200,000 value. The fair market value of the partnership is $200,000. 10% divided into 20,000. Or what's you look at the whole. What is the whole if 20,000 is 10%? $200,000. The current capital balance is 100, and it would be 120 when he gives his $20,000 cash. Okay, so he's willing to give 20,000, so it's 100,000. You would have to include his 20,000, so after the contribution would be 120. Well, no, it should be 200,000. So that difference of 80,000 will be debited to an asset, goodwill. The capital accounts of King and Wilson will both increase by their profit and loss ratio of that 80,000. Then admit Goldman, debiting cash, crediting capital. So he's admitted, and his capital account will be whatever assets he contributed. That's the Goodwill method. You revalue your assets to fair value, basically, based on what the new partner is contributing and what new ownership percentage you're taking on. Now, there is a hybrid method. In this example, and this is on page 438, let's say instead that there's a piece of land, this is on the bottom of page 438, that a piece of land held by the business is actually $30,000 more than its current recorded book value. Thus, the identifiable assets of the partnership are worth $130,000, and Goldman pays $20,000 for a 10% interest. Well, first, let's increase that land value, $30,000. The $30,000 is allocated to each capital partner based on their profit and loss ratio. Then, when Goldman is admitted, so we're only increasing the assets to their fair value. We're not looking at an overall value of the partnership to determine goodwill. So this is why they call it a hybrid. We're actually going to bring him in under the bonus method, where cash will be debited for $20,000. He's going to get a 10% interest. Well, where do they get that 15? Well, capital or the net assets are worth $100,000 going in. We just revalued them, increased them another 30. And then Goldman gave $20,000 in cash for a 10% interest. So the 10% interest is based on a $150,000 capital balance. So 10% of the 150, credit Goldman's capital for $15,000, but he gave $20,000 in cash, so that remaining $5,000 is a bonus to the other partners for them admitting him into the partnership. So we'll allocate that based on their profit and loss ratios to their capital balances. So that's the hybrid method. So we have the bonus method, the Goodwill method, and the hybrid. Okay. What happens if it's the new partner getting a bonus? So we've seen where we have a new partner coming in and they're giving extra money, taking less of an interest up front, meaning less of a capital balance than the money they're actually putting into the partnership. So they're actually paying their way in. What if the opposite happens? What if they pay less than the capital interest they're receiving? When would this happen? A partnership really wants somebody to be a partner. We're willing to give you more of an interest than the asset you're putting into the partnership. We'll suck it up because they know this person is going to be so awesome for the partnership. Let's take a look under the bonus method. Now, in this situation, top of page 439, we have here where Goldman is getting they don't give us the background in the slide, but a 20% interest instead of a 10% interest. 20% interest instead of a 10%. So going in, we have under the bonus method, old capital balance is $100,000. Add the $20,000 that Goldman's putting in. Now the total new capital balance would be $120 times 20%. His new capital balance will be $24,000. So that's where they get that. Credit Goldman's capital $24,000, debit cash $20,000. Okay. There's a difference there of $4,000. King and Wilson say, decrease our capital balances. We'll give up that much cash. We'll give up the $4,000 in total just to have him as a partner. So 60% of the $4,000 difference is debited. It actually decreases the capital balance of King, and $1,600 is debited to Wilson. Now, with the goodwill, you would do the revaluing, okay, according to the calculation. It gets kind of hairy down at the bottom of page 439. So in this case, they're saying, okay, he's willing to give $20,000 for a 20% interest. So we have to figure out, how much is this worth? What is the goodwill? Because they're saying the opposite is going on here. So here's the algebra. Goldman's capital equals 20% of the partnership capital. Therefore, 20,000 plus goodwill equals 20% of the 100,000 plus the 20,000 he gave plus the goodwill. We're trying to find the value of the partnership. Now, we will work that down algebraically. Goodwill is $5,000. So you would have to use this formula. So really, he's getting a $25,000 capital balance, even though he's giving $20,000 for 20% interest. He is getting a capital balance of $25,000, debiting cash 20 grand, debiting goodwill $5,000. And that's how they come up with that. So all different ways of bringing partners in. And you could account for them either as bonus or goodwill on top of it. What happens when a partner withdraws? So now the partners are ready to go. The withdrawing partner is paid out in accordance with the partnership agreement. It's normal. Using the bonus method, any amount paid in excess of that partner's capital account is allocated against the remaining partner's capital accounts. What does this mean? Take a look on page 441. Here we have Duncan, Smith, and Windsor at the bottom of page 440. There's their capital balances. Okay. Windsor decides to withdraw from the partnership, but the business is going to continue to operate. Following Windsor's decision to withdraw from the partnership, its property is immediately appraised. Total fair value is estimated at $180,000, a figure $80,000 in excess of book value. Okay. It goes on to say Windsor will receive $26,000 on leaving the partnership. The $10,000 capital balance that he has plus 20% of the $80,000 increase in fair value, the 50 and the 30 added together. So there's the cash. Cash is credited $26,000. Windsor's entire capital balance will be debited $10,000. And then Duncan and Smith's capital accounts will be debited for the difference, because they'll get that fair value out of the company when they leave later. So we take, this is called bonusing the new partner, actually, it should say, we're giving a special amount more money than is actually in the capital account to Windsor, but that's because the assets are worth more when he withdraws than are on the books. The Goodwill Method says adjust everything to fair market value and adjust all the partners' accounts and then withdraw the partner. So that's accounted for down at the bottom of page 441. Let's increase the land account to 50, increase goodwill to 30, distribute that $80,000 fair market value increased to the partners. Then withdraw him at $26,000, which will be his capital balance, and give him the cash, $26,000. So we still even have that bonus and goodwill method when a partner is leaving the partnership. Okay, so that's partnership accounting. Remember, it's an association of two or more people to carry on a business. The form of business organization is popular. There are tax benefits. Disadvantages include the big one, unlimited liability and mutual agency.